On today's show, kind of three questions. Number one, what's a vibe session? And is that why Trump won? And number two/3, so where do we go from here? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Just two of us again, Rabih. This is 3 or 4 weeks. Is this just becoming the Rabih and Matt show? I don't know.
It is. I love it, but it's exhausting coming up with material. I want the advisors back. They're too busy with their clients.
We got to fill the time with just the two of us. So again, end of year stuff. It's just hard to get some of the advisors on. It's really my fault. We're giving people a little peek behind the curtain. I tend to fill out the schedule 6 to 8 weeks in advance. And then as it kind of comes closer and that schedule's filling up, meaning I kind of do a rotation of the other advisors every 6 to 8 weeks. But I screwed up this time and we went into end of year meeting. So it's a set schedule for you and me. And then I just rotate advisors in. But because I waited too long and because our advisors are so busy changing lives of their dentists for the better, they're so busy with that, we could not get them on the schedule other than last week for Jake. But every other Friday, and because most dentists don't work on Fridays, I don't know if you know this, Rabih, but Friday, they don't really work a lot. And so Friday tends to be our busiest day. And so anyway, just you and me again, hopefully in the next week or so, a couple weeks, we'll be able to get back to our regular rotation. Let's jump in. Something happened this week, Rabih. I'm not sure if
Nothing
you heard.
really happened. Yeah. I don't know why we need to have a 2 cents to start with.
I know. I looked at you as we were getting ready. I was like, you got stuff to cover? You're like, oh yeah. So we have a lot to cover today. It's going to be mainly around the election. Number one is, what's a vibe session, and is that why Trump won? We are, first of all, as I think everyone knows at this point, we are not political commentators. We are not experts in any way of policy or politics. But I did think this was interesting and I think a solid way to set this up of what happened. And we've been talking about this for a while, Rabih. This has been a theme. And an influencer, this Kyla Scallon, she actually created a term for this in 2022 called a vibe session. And what that basically, the definition of a vibe session is this a disconnect between consumer sentiment and economic data. And it's cool to see that someone put a word to it. And we've this has kind of been a theme throughout our shows of over the last year, what is happening? The economy keeps getting better by every metric. It's booming, but we keep feeling like the sentiment out there is disconnected from that. So there's data behind this. An NBC News exit poll showed that 45% of voters say they are financially worse off than they were 4 years ago. That's the highest since 2008. Yet by every metric, every economy metric, a metric of the economy is dominating. It's booming. Inflation's down. You can look the job market, everything you can look at, the economy is doing well. But yet almost half the voters said they're financially worse off than they were a year ago. So again, I think the question as we talk about this of where do we go from here is just to set this up of, I think this is why Trump won. I don't want to be too simplistic about it. And I think it comes down to basically one thing, which is people are still feeling inflation and everyone hates inflation. And for better or for worse, right or wrong, not saying it's right, but I think most people attribute it to the current regime, the current president and his team. They again, not saying it's right, but that's the narrative and that's the feeling. And I think that's why Trump ended up winning. What say ye, Rabih?
No, I agree. In the election, there were multiple issues on the ballot, and the Americans had to choose which one is the most important to them, and thus choose to vote on it. And it happens to be that the economy was the calling. Everyone wanted a better economy, and we're going to get into the data in a sense, and we'll see whether the American feeling is in line with the data. And whether it's not, the hypothesis is that Trump has capitalized on it, and good for him, But it might be looking on pen and paper that the economy is the best we've ever had, and that's why we have had spectacular growth across asset classes for the last 2 years. But let's get into the data. I'm really excited.
Well, and before I know you're itching, but before we do, I want to just be fair. We're, again, to be clear, we're not saying we're pundits or experts on this, but and I'm not saying it's the only reason Trump won, right? There's probably people out there shouting right now, they're in their cars, like there's 10 other reasons why he won. But we're going to break down. We wanted to set this up to say this vibe session is defining what we've been saying forever, which is this disconnect between consumer sentiment and what's actually happening. And then we want to spend the rest of our time talking about now what you're itching to talk about, your 11-point agenda here of where do we go from here? I think this is what most people want to know. Like, okay, we're a couple days removed. The markets are just booming right now. But let's talk economic policy, inflation, the Fed. Where do we go from here, Rabih?
Yes, and let me preface it that the market doesn't really care. Before the elections happened, we did a bunch of episodes and podcasts saying that the stock market does not care about who wins the elections, and your portfolio really is not affected, especially on the long run, by who wins. So just now, because we saw market movements, it doesn't mean that we are changing our statement. The market still does not care. What has happened is that the stock market, as an information crunching machine, has now got rid of the uncertainty and got a certain path of information that they are following. And that certain path of information happens to be helpful for financial assets. So let's get into it. So
yeah, I was thinking really quick though, Rabih. You said we've been saying forever that the market doesn't care, and then Trump wins and the NASDAQ says, hold my beer. I'll show you who cares.
Actually, it's very fascinating. As I show you the numbers right now, you'll see that every single asset class reacted, but every single asset class reacted indicating a different messaging. And
okay.
You'll see it in a second.
That's why this story time.
Super interesting. Okay, so we will start with let's start with volatility, because that's the elephant in the room, and textbook wise is what explains most of the rally that we saw across all asset classes. This would like contribute to 70 to 80% for why the market went up. And before elections, we're talking November 4th and early morning on the 5th, the VIX was around 22. We said the long-term average is around 16. It gets elevated during election, and it just indicated that a lot of people were hedging for their portfolio, especially institutional asset managers. So on November 6th, when we woke up and we figured out that the results are out there, the expectations in the market at that time, and not only the market or the whole country, is that this is going to be a very contested election. We might not know the results for a couple of days, right? Let's hope there is no
by 8 o'clock at night.
Yeah,
that was what's crazy.
Let's hope that there is no, political tension after it. There's going to be indications of a peaceful transfer of power. And this is what the market wants. The market wants democracy to run smoothly and not cause it headaches, so a capitalist economy can run its course and create value, right? So the fact that there was a positive surprise, just like what you get when earnings are good, or when the Federal Reserve goes up and tells you, hey, the economy is doing better than we expected, we got a political risk that showed up on the positive upside side of things. We had a very quick results that dissipated any tensions. We've got, concession that happened shortly after. And on top of that, we got more of a sweep. We got a one-party government, both executive branch and legislative branch. And that provided a lot of information. So the fact that the VIX jumped from the 22 level to going down all the way to 15.7, which is at around the long-term average, this means that volatility dropped by 28%. So just the fact that you see a lot of hedging / speculation on the downside disappear from the market, and the fact that uncertainty dissipated away, mathematically this rises the price of financial assets, because the risk component is now reduced. So that was, I would say, the biggest portion for why the market rallied up. Then the second portion for why the market rallied up is that you got a one-party government, because given the party that won, the Republican Party, we knew ahead of time kind of what the policies are going to be. This is what the candidates ran on. Trump ran on certain policies, and Kamala did so. So getting a one-party government will have a different reaction from the market than having a fixed government, because one might have a lot of push and pull and might not go anywhere, where the other might actually have a chance to place laws that have an impact on financial markets.
And you're saying, Rabih, just to clarify, you said it earlier, of like just the lack of, or the now we have more clarity. You're saying the market doesn't necessarily make it a determination, like, let's say, moralistically of what they like or don't like as far as policy. You're saying the market's reacting just the fact that we now have clarity, that we have a one-party system, something's going to get done. The market as a whole likes that certainty. It's not necessarily saying the market may or may not like Trump's policies specifically. They just like that we have certainty around it. Is that what you're
100%.
saying?
Okay. Yeah, and what I'm saying, I'm not discrediting the part that they might prefer Trump's policies over Kamala's policies. What I'm saying is that the majority of the movement can be explained by the fact that the certainty is now there, rather than one candidate won over another. The second point is that it's a one-party government and not just a mixed government. We'll just disregard the Democratic agenda for now, because it's a dead end for them. But for the Republican agenda, Trump was running on, removing a lot of tax cuts, especially, on Social Security and on tips, those populist fiscal policies that rally people. And on the other hand, you've got the trade tariffs on trade, especially with China, that he's been running on. This is one, but I think those are there's still uncertainty whether they're going to pass in Congress or not, whether there's going to be filibuster. We'll have our fair share dealing with the politics later. But if there's something certain that the market could price in right now, is that the Tax and Job Act that expires end of 2025 is now extended its lifetime. And the probability that would have disappeared was higher, as we talked in previous podcast, because anytime you've got a mixed government, it's most probably that they'll fight and that would not be extended. But now that got extended, and that gives another boost to the market. And the third one was just this election was unprecedented in the amount of betting that was happening. There were contracts on each type of candidate, and you could see it in specific stocks, talking about like Trump Media or Tesla. And that is the residual part and this is the part that says, yes, just because Trump won, they are going up, So a lot to digest there, but hopefully it provides a framework of like, let's decompose the movement into the major factors that contributed to it and look at it from a more textbook perspective.
Really quick side note, Rabih, on the betting. Did you hear about? I think this was the same guy we talked about, the French investor.
Mm-hmm.
I think it was the same person. He put like $50 million on Trump. I heard this morning, I believe it was the same person, that he built his own. He put out his own team on the ground in the U.S. to go out and do his own surveys, and ask the question of not who are you voting for, but who do you think your neighbor's voting for. He like changed the question. And he got enough data back from his research on his own that he put $50 million down, which I thought was crazy. Good for him. Good for him.
Yeah. This is the only case where you can outsmart the market, you can beat the market, is because you have material information that you collected. It's not that you're receiving them in an illegal manner. So if you have the fiscal and like the capital capability to go out there and collect data that is not illegal but gives you an edge over the market, then go be an active trader.
Yeah, go do it.
This is what hedge funds do, actually. A lot of money is spent in the hedge fund industry on trying to collect information that is not illegal but gives you an edge. So good for him. This is how the game is played.
Can we go back to one thing you said just before we move on to the volatility thing, because I want to clarify this. I kind of get this sense of like this chicken or the egg thing, meaning you said volatility is now down below or right around historic averages, and the market is. I guess here's my question: does the market react to the volatility dropping, or does volatility drop because the market is going up, or is it kind of both?
No, actually, that volatility, the VIX volatility, is not what is happening in the market. It is what we expect volatility to be like. It's an implied volatility measure in the future. So to answer your question, no, you look at expectations of volatility and the market reacts to that.
Got it. So the market sees expected volatility is dropping, and that is a driver of market returns in the short term.
Yes. We talk about the correlation between like stocks and bonds and how it sometimes flips, etc. The strongest correlation out there in the market is between stock prices and the expected volatility, and it's usually around negative 95%. So it's a very, very strong
literally
negative correlation. Yes.
Got it.
Completely opposite. Okay, so that is the VIX. We discussed it. Now let's talk about equities and see what story they give us. So where is my graph? Okay, so the S&P 500 it jumped. Sorry. Hold on. Okay, so the S&P 500 jumped by 3.73%. The Nasdaq.
Day after.
Like when the results. We're talking November 6th because November 7th, which is yesterday, we had a different news. We had the Federal Reserve talking. So that now the data. We're going to get to that, but this means that the data has been mixed a little bit. So let's just look at the performance on November 6th. S&P 500 went up 3.7%. Nasdaq went up 4%, but then the Dow Jones went up 4.6%. And here's what's interesting. The fact that they went up, all of them, is explained by what we just covered. But the fact that they did not go up at the same rate, this is what a portfolio manager would look at, tells you that there is one bias towards a certain company than the rest, right? And on top of that, also, you've got small caps that went up. Let me pull it up. Sorry, we can cut this out. Okay. Small caps that went up around 6% for the...
Whoa.
For the period.
That's got to be some level of sentiment around a narrative of deregulation, I would imagine, by a Trump policy, which would greatly impact small cap stocks versus anyone else.
100%. So there's the fact that the Trump would be better for smaller business, and that sentiment has been priced into the prices. But the other idea, and this has been something that's been showing up since 2021, I would say 2022, when inflation was there, is the difference between the performance of the Dow Jones versus the performance of the Nasdaq. The Dow Jones is more value oriented, where the Nasdaq is more growth and tech oriented. In an inflationary environment, you would expect the Dow Jones to do better. And that's why it didn't go down as much. In 2022, just to give you context, Dow Jones went down 8% for the year, whereas the Nasdaq went down 30%. So in an inflationary environment, as theory would tell us, we would expect value companies to do better than growth companies because the Federal Reserve is coming in, increasing interest rates, and that harms tech companies, growth companies, because they're more sensitive to interest rates. So the fact, and vice versa, if we were expecting a recessionary mood, we would expect growth companies to hold up better than value companies, because in a recessionary environment, growth companies have more momentum to get their way out. So the fact that with this uprise, we expected not just the economy to do overall better, but also value outperforming growth for that one single day, throws in a little bit of inflationary worry, which is something very interesting to look at. And this is one part of the story. So you've got stocks all going up, but also stocks are going up to an extent where a little bit of inflationary worry already got priced in, as in the Dow Jones went up larger than the Nasdaq. And actually yesterday, when the Federal Reserve cut interest rates, the Nasdaq went up more than the Dow Jones, and they kind of recalibrated each other.
That's wild. Yeah.
So, and it's good when you see such indicators in the market. You might be completely off, but we're looking at like what we know from the textbook about the markets, and that just fits the narrative to the dot. And now we talked about volatility, we talked about equities and the variation between them, but now let's talk about, I think, the elephant in the room, which is bonds. While everyone was celebrating equities, and this is US equities, there was a bloodbath in bonds. Bloodbath. It was crashing. So,
which is funny because, sorry, the irony here is the bond market is what, 4 times the equity market?
Yes.
But it gets the far less attention because the fixed income market, the bond market, is where the quote unquote smart money, the professional money, is institutions play. A lot of individuals are not in bonds, so you're not seeing it as much. So like you said, Rabih, everyone's talking equities, and then behind the scenes in a much larger market, completely different story. So yeah, I'd love to talk about that.
Yes. So just to preface it, we know we have the yield curve, we have different maturities. The Federal Reserve controls the front end of it. We've covered all of this. So now let's just look at the 10-year Treasury, because this is what the market uses as a rule of thumb to look at the health of the bond market. And the yield on the 10-year Treasury, I'm not giving you, well, at the low point, we went down all the way to like 3.6 when back in like August and stuff. But it went all the way up to 4.5%. But the day over day jump in the 10-year yield was 3.4% to the upside. And as we know, when interest rates go up, they went up overnight by 3.4%. You would expect bonds to go down, and this is what really happened to bonds. I'll show you the prices in a second. But you also expect equities to go down. So there was a mixed signal between what happened in the equity markets and what happened in the bond markets, completely opposite in a sense. And there is kind of an explanation to it. Just to give you some reference, if you look at the U.S. aggregate bond ETF, it's not maturing at 10 years. It has more of a duration of 8, but also it gives you the price perspective. It went down around 1% overnight when election happened. So interest rates went up and bond prices crashed down. And
okay, can we hit on this for a second, because I don't want us to take this for granted of like what this actually means. Can we just slow down for a second and break down when we talk about, so there's this inverse relationship between yields and bond prices. And so that can tell us something. When yields are going up, bond prices are coming down. Mm-hmm. Can we talk about the importance of why that movement matters? Or like, what are you thinking about or looking at when bond prices are coming down? What is that indicating? Obviously, again, yields are going up, but what is that indicating as this kind of bloodbath in the bond market? People are selling off bonds.
People are selling bonds,
okay,
and they could sell it for more than one reason. And until now, the market hasn't decided for why. So you can look at the equities and say, oh, the equities are up while the bonds are going down. People are selling their bonds. They're buying equities. They think the economy is going to be strong. That's one. Two, you could look at it and say, oh, bonds are going down. People are selling them because the Dow Jones did better than the NASDAQ on that day. There's inflationary pressure. We don't want the nominal value of our dollar to go down, so we're going to be selling bonds. So there are conflicting messaging. But given that also the US dollar went up, gold went down, we're going to talk about this in a second. It seems like they are selling out because of future priced in future expectations of growth. This is although there's inflationary worry, but it's more optimism about real economic growth than it is worry about an inflationary hit.
So you're saying, Rabih, that your narrative, if you had to guess, is that it's more of just a capital shifting from bonds to equities because of what's happening in equities, and it's more of a sign that people are expecting the economy, now that Trump's in office, to do better, as opposed to a real sign of like worry.
More likely
inflation.
than not. More likely than a worry. But this is the market interpretation. But an economic interpretation would say you never want bonds to go down. So does this mean that now they're afraid of a budget situation where the value of the US dollar isn't as important, and that's why people are exiting bonds, because the symbolism of the US dollar is being hit? There are so many different interpretations and that's why you can't really understand or predict the market by just looking at prices, although we're trying to do it today. Just because
that's exactly what we're doing right now.
Exactly what we're doing today, which is wrong. But it's kind of like, okay, let's look at all the different scenarios, all the different information the market is giving us. This doesn't tell us that we're going to be able to predict. On the contrary, but this at least narrows our space of different possibilities. So as time comes, as the months roll in, as the years roll in, we'll know which path the market has taken. So the fact that bonds had this sharp movement just tells you that either capital is moving of stronger growth, or there is a worry that the federal government right now will not be as fiscally responsible as we would expect. It's a fact that the Trump presidency added a lot to the deficit and to the overall debt, whether it was pre-pandemic or during pandemic, so that the smart money in the market also takes that into consideration.
So you're saying there's a possibility of this, and again, we're speculating right now, but we're trying to highlight the different narratives of what this could mean. There's another possibility here, and it could be a combination of these things, and most likely is. You're saying the other possibility here, another big one, is that let's say foreign investors or professional money managers are immediately moving out of bonds, the treasury bonds specifically, because of what they think it could mean to what Trump did last time to the deficit, or what they're anticipating his new policies he's wanting to put in place could do to the deficit and the spending and all that. So you're saying it's most likely a combination of these things.
It is a combination
of
these.
That people are exiting treasuries because they're worried.
It could be. On the long run, it could be a very valid hypothesis. I'll let you know what the Federal Reserve said in a second.
Okay.
Okay. And then we've got, I'm going to run a little bit quicker through those. We've got emerging markets and developed markets going down around 1.7 and 1.5% for the day after the election, as well as gold dropping around 1.8% for the day. And those three together kind of give the same information. It's the America First policy and an America First agenda, especially and this is what hints at like tariffs, because that would mean more money flowing into the US, although it doesn't make the bigger economic pie bigger for everyone. It's just moving money from one region of the world to another region of the world without it actually being a net positive overall for everyone. So you saw these going down, but this is just to build on the narrative. So we talked about how global equities are doing, how gold did, how treasury did, how volatility did. And there is a mixed signal, as we've noticed, because each asset class showed positive strengths and some concerns. But overall, the image is positive. That's why we're still up. We're making all-time highs. But it's not a completely 100% rosy image. There's inflation worry, there's deficit worry, and there is U.S. centrism worry, which honestly just makes you worry about what you would hold in your portfolio outside the U.S. So with that, this is just what the market did. You can take it you have to take it with a grain of salt. This is one-day performance, and this is a lot of it isn't what the people are now thinking. It's a lot of it people unwinding trades about what they think was going to be happening. So let's move to a more grounded perspective about the market, rather than the excitement of the stock market and the bond market, and go to the Federal Reserve meeting that happened yesterday on November 7th.
I don't know why you want to get grounded, Rabih. It's kind of boring, but yeah.
I know.
Fine.
I'm sorry.
Yeah. How dare you be nuanced and neutral and grounded?
So the Federal Reserve yesterday went on and they cut interest rates by 25 basis points. It was very much expected in the market that this is what's going to be happening, given that they cut by 50 basis points the previous meeting. But the conversation was really different. The press conference with the Federal Reserve this time focused about elections, about where we go from here. And that's the question for it. And we found it very interesting. Let's start just by saying that the market, based on like the summary of economic projections that they released in September, the market was pricing in one more cut in December for 25 basis points. That is now, according to what the Fed is, up in the air. It's more data dependent. We'll know in December whether there are going to be no cuts or a 25 basis point cut. As for the year 2025, the summary of economic projection has told us that over the year in 2025, we're going to be seeing interest rates going down by a full 1%, which is probably going to be 4 different 25 basis point cuts somewhere throughout the year over the next 12 months. So what the Federal Reserve said regarding the summary of economic projections is like, we are in between. We're in November. Don't worry about 2025 until we release something in December to tell you about it. So December's meeting is going to be very meaningful on the path for interest rates in 2025. Are they going to deviate away from their plan for a 1% cut throughout the year, or is it going to be different? Especially that now market is pricing probably higher growth and a little bit of an inflation worry, right?
Well, okay. So really quick on this, Rabih, we talked about inflation before. We talked about why a huge factor here of a Trump victory, I think, is this as we started the show with this vibe session, which really just speaks to inflation, and this being a worry. And by the way, this goes outside the U.S. as a side note. There's been global inflation since COVID, and pretty much every single, almost across the board, every election across the world over the last 2 years has led to an incumbency being ousted, and all of it because of inflation. But here's, I guess, the question I have on this, and just more like open-ended, us kind of thinking about this. We talked about this a little bit last week. Should we be cutting rates right now?
That is exactly the question they asked the Fed. Great segue. I don't know. Did you watch the press conference yesterday? How did you know?
I did not. I did not.
Okay, let me go through the points really quick. Here's what they asked them about the election for the first time, and it's like, does this change stuff for you at the Federal Reserve? That was the first question they asked him. They didn't even care that he got interest rates, and he said, all what's happening in the election, all what's happening in the market, which what we just covered, which was a lot, has no effect in the near term. He's like, just like Congress can create laws that are impactful, we will have these in the models when they happen. So for now, for him, all this market movement does not care in the short term. And the Federal Reserve has a dual mandate of full employment, price stability. He's like, all of this does not matter. And this is what we've been preaching. Your portfolio does not care on the long run. The economy does not care on the long run about who the president is. It's only when impactful changes happen, and this is required by laws that are signed by all branches of government, except judiciary, that they're going to make a change. So he's like, there's no effect in the near term. He said the spike in the interest rates, the 10-year that we just talked about, are more indicative of upside risk and not downside headwinds. So remember the whole thing of soft landing versus a hard recession. Now we're like pretty sure we're going to be in a soft landing. The recession is kind of losing favor in terms of the odds, simply because of a Trump presidency is fueling the expectations of higher growth. But now there's upside risk. There is the risk of inflation, and they asked him about the cut. They asked, did the S&P change what they are doing? The answer was that he mentioned the word recalibration, if you remember it, like 7 times.
Yeah. Again? He said it again?
He said it again. It is the theme right now. We're now moving to something called recalibration. We had transitory, then we had bringing inflation down to 2%, and now we have recalibration.
Wait, but so going back to your point, the first one of saying he's using the term and referencing upside risk, indicating that his worry, or he's at least focused on upside risk being inflation, and yet they cut rates again.
We're getting there. I'm still teasing you.
Sorry.
Getting there.
You keep. Yeah, you're just dragging me along. I like this.
Actually, to be honest, I have 11 bullet points. I know it's somewhere, but I'm going in order because I don't know where it is.
Perfect. You're like, somewhere in these 11 points, we're going to get to that exact thing, but I don't know. Let's keep going.
I wrote them in order.
I love this. Okay, I'm going to put a pin in that.
Okay. Oh, why are you cutting at all? This is what they asked him. And his answer was like, we have a dual mandate of full employment and price stability. He said, we believe that monetary policy is still restrictive at its current standing. Current standing is that interest rates are between 4.5%, 4.75%. According to the Federal Reserve, even with the cut that happened yesterday, the monetary policy is still restrictive. And he said, we have waited in July, and we did not cut interest rates in July vis-a-vis other developed countries because we wanted to get to a point that we are confident that inflation is going on a sustainable path towards this 2% target. So the fact that they waited made them more confident that inflation is getting to its path of 2%. So all the cuts that they have planned out will not have an impact of swaying it off its course, because it is now on a sustainable path towards the 2%. So what he's saying, we are cutting not because we think it's going to stimulate the economy. We are cutting to go back to what the equilibrium interest rate is supposed to be, because right now it's restrictive. Did I answer your question?
Yeah, you did. Actually, I'm just sitting here thinking that's quite the needle to thread, because you're also battling not only what you're doing with your dual mandate, but now you have a new president with a new regime. We kind of know, based on the Trump playbook, what's going to happen. And I'm thinking of, let's just take one category that we know Trump has been running on, which is tariffs. And I would imagine that's got to be something that you'd think the Fed is thinking about when it comes to inflation, when you have lowering rates and then tariffs on top of that, with already kind of this kind of teeter-totter between recession and inflation. I would imagine it's a concern, right? If like all of a sudden Trump does implement his tariffs, that's highly inflationary.
That is highly inflationary, depending on the products which get tariffed,
and the infrastructure we have in the U.S.
depending on how the market participants, especially the U.S. dollar, would react for inflation, for tariffs. And the main important one, it also depends on how whoever you're putting tariffs on reacts. The reaction has more impact than the tariff itself. So if a trade war happens where they start doing tariffs on your exports, this might slow down your economy. So while you're trying to stimulate your economy by doing tariffs, your adversary reacts and ends up putting you in a recession. So it's a very tariffs and on pen and paper are supposed to help domestic producers and just make it a little bit more expensive on consumers, but will give the money for the government. And that's the idea. He wants to finance the tax cuts with bringing more money for the government. A tariff on pen and paper is supposed to help producers while hitting consumers a little bit domestically, in the hopes that the producers are going to grow much faster than what the consumers will be hit with the higher prices on their goods, and keep the economy growing faster than other countries. How the market reacts, and how, especially in this globalized economy where money is free floating and can switch from one country to another in a split second, and how the other country will react to it, makes it so complex and so hard to determine what the outcome of a tariff move is going to be.
Sure.
So we'll just put it out there. The next couple of points are very interesting. You were saying about threading the needle, and he literally gave the analogy. He was like, we are slowing pace similar to an airplane reaching the airport. So you would be running at a very high, quick airspeed, but 15, 20 minutes before you land, you notice that the airplane although it's still at the same level, starts slowing down its speed before it starts descending. And this is kind of what they're trying to do. More of a homage to the soft landing.
Yeah, exactly.
Thing that he wants to say. So he used it as a thing, but the mood quickly changed. They asked him twice. He said, what would you do if President Trump asks you to leave? Would you resign? And he just, his facial expression changed, and he said one word. He said, no. That's all he said.
Yeah.
And then 2 or 3 questions later, they were like, aren't you required to leave? And he was like, no. And that's all. And then he looked for another question. And then they asked him again, and he said, it is not permitted under the law. And he moved on. He was very, very stern. And, this is the constitutional right. A governor, the chair of the Federal Reserve is of the same political standing as a governor. So just like the president can't remove a governor of a state, he can't remove the governor of the Federal Reserve. And until the term ends.
Well, and whether or not you believe him is up to you. I'm not going to make a determination on that, but Trump has publicly said, as of even the last 6 months, that he is not coming for Jerome Powell. So whether or not you believe him, whether or not he sticks to that, he has made public statements that are on record saying he's not coming after Jerome Powell if he were to be elected. So I guess remains to be seen.
Well, objectively has done a good job. It'll all depend. Flashback to 2018 when there was a little bit of bickering between Trump and Jerome Powell over the path of increasing interest rates. In anticipation of what the recession happened, we need ammunition to be able to protect the economy, cut interest rates from monetary policy. Jerome Powell was in favor of that. Trump was not. And there was the whole Christmas 2018, if you remember. So given that they have history, those two have history, we'll see how it goes. Now, asked about the fiscal situation. He is the monetary policy authority, but he was asked about fiscal. He said he's not going to comment. It's the government. It's the government's thing. But here's what the Federal Reserve said, which is important to how the interest rates are going to be moving. He said the fiscal path, and it's not the first time he says it. He said it more than once. He said the fiscal path is unsustainable, but the level is not, which is very important to think of. We made a whole 2 cents episodes about the federal deficit and the federal debt on 4th of July. Happy birthday, America. That's where you can find the episode, talking about how much debt the US have, how it's broken down, etc. And the last 2 presidents we've had, both Trump and Biden, actually increased a lot of that debt. They contributed to its increase by a lot. So the path by which the last 2 presidency had on the federal debt is on a very unsustainable path. But is it 100% debt to GDP that we are in right now unsustainable itself, the level? No, we're fine. We can still service the debt even if interest rates are high or interest rates go down. It's just the growth that we've been seeing over the last 8 years, if continued, is really bad news to America and the global economy. And we know that. They've just been kicking the road down the can.
Yeah. So, okay, I see what you're saying. We have to slow the path, basically. We can't be continuing on this path of growth and this deficit spending we have. I think this is kind of agreed upon across the board that we've got to figure this out.
Yes.
Whether or not it's Trump or someone else, like whether or not he can do this, like I think we all kind of agree we gotta do something about the government spending and the debt that's being taken on.
Well, the time will come, right? The Trump kind of actually also ran on it. Not Elon ran on it.
He said Elon ran on it. Yeah,
we're going to be reducing a federal deficit by $2 trillion. Until there's a law, until there's an administration. I'm speaking like from what the market thinks. This is still just political talk. Let it be on pen and paper, and then we can price it, and then we can think of it. And then the last question that they hit, and I think this goes full circle, Matt, because it's about the Vibecession.
We know what we're doing here. We know what
we're doing here. That's why I stick to the order of the bullet points, right?
Exactly.
So they were asking about the Vibecession. They said that they kind of acknowledged that inflation had a big thing to do with the elections, and they asked Jerome Powell, like, you keep saying that the economy is doing really well, and objectively it is really doing well, but the American people do not think so. And his answer was in the lines of, what do you say? He said, it takes real wage gain for them to feel better. We respect their feeling, but the economy is in the form to provide them that real wage growth. So what he in a sense, he's saying they are not feeling that because the behavioral aspect is different than pen on paper. On pen and paper, Americans are doing well. And I actually pulled up the numbers on my end just to really look at it. Real wage growth year over year since Q4 2022 has been positive. So 0.27% in Q2 if you look at the last 12 months, 1.6%, 1.1%, 2.2, 0.5, and 1.3. And these numbers, each one of these is a quarter from Q2 2022 until right now, Q3 2024. Every single quarter, the amount was positive. It might not be high. The real wage growth is 0.5, 1.1, but this is real. So this is after inflation. So if inflation has been 4 or 5% back in the days, you're talking about a nominal wage growth of 6 and 7%. So on pen and paper, real wage growth has been higher, but behaviorally speaking, it hasn't. And this could just come to the fact that American people, inflation is a second derivative. So people are looking at prices, they see them high, and they say, oh, it's inflation. Now inflation went away, but prices are still high, and they think it's still inflation. Inflation is the growth in the prices. We do not expect them to keep going up, but they're not going to go down. And honestly, if they go down, it means in a recession we have different problems.
Yeah, we don't want them to go down.
We don't want them to go down. This is where they are. Sorry to interrupt. But in a sense, the idea right now is that because Americans saw prices go up, even if they stabilize at this higher level, they are still sour about it. This is what's causing this Vibecession. This is what's causing this dissonance between the behavioral aspect, what they feel, and what is happening. On pen and paper, the economy is really doing well. It's just we need to readjust our expectations about and really know how the economy works to try to assess it more objectively.
Yeah, there's so much here, Rabih. I mean, there's a whole other show here just about like the psychology of all of this. I think that's really what this is the average everyday people, or everyday people are not wading in the waters of economic data. They're not reviewing the economic data. And
what are they doing then? Come on.
Yeah, Rabih, I was hesitant to say normal people like you and me. Normal people like me, and then there's you. There's a different category. There's levels to this. But I think this speaks to the fact that you hit it, I think, right on the head, that people see like the prices are sticky. So even though inflation is way down and has been coming down ever since basically 2022, 2023, like all 2023 and all of this year, prices have been coming down. Inflation's really been put under control, but it doesn't feel like that because the prices have stuck and we've anchored to the lower prices, and it still feels like, man, everything's so expensive. And then to the wage growth, again, it's the difference of like looking at the data, and then it's like, well, yeah, okay, the data shows maybe my wages are up, but not nearly as much as what inflation did over the last 3 or 4 years. Like, it's just not the same. I just think there's a lot of psychology to this. There's a lot of people are not living in data like you. They're just reading the stories, and the story is inflation is still a problem. The Vibecession is really just a matter of, that's why I like what she called it, vibes. It's just vibes. And for whatever reason on the streets, people are still just feeling like it's not great, which is crazy because literally across the board, it's amazing. Like the economy is as good as maybe it's ever been.
Yeah, true. It's the best it's ever been, and it's fair. And he acknowledged it, and it's like, we understand and respect the feelings of the American people. And the solution is just, if the economy stays as is for now, you're gonna be not only on pen and paper, you'll continue to do better. Also, behaviorally, it'll shift because inflation is completely under control and real wage growth is growing. Real GDP is above even the 2% mark that is set as a target. So just give it some time. If the economy doesn't shift in a different direction, just give it some time, and that feeling hopefully will change. Americans will anchor to higher prices and feel that those higher prices are, back to being nothing compared to what they were.
Yeah, and there's still a lot to figure out. Obviously, we are just on the barely on the heels of this political shift. Obviously, with the election, still a lot to come down the road of what Trump ran on. You alluded to this earlier. What Trump ran on, and then obviously the difference of political rhetoric, and then actually getting something in place. I think there's things that if he does put in place could have a real positive impact. Let's say on things like real wage growth. But again, or on government spending, to what you've said, Elon has alluded to, of cutting government spending he's mentioned like $2 trillion, like you said. We'll see if that actually bears out and goes from political rhetoric to actual implementation. I guess if there's any time to have something done, it's going to be now, because he's pretty much has the government across the board, right? 100%. I mean, we're still waiting for the House, but it's looking like it.
And the economy is in a position that could, look inwards and try to solve and optimize from within. You do not want to deal with your deficit problem when you have inflation or when you are in a recession and you're required to borrow. This is the right time to deal with a deficit problem. This is my own personal opinion. Everything I said before was not my personal opinion, but right now this is my personal opinion. I think it's only when the economy is doing really well, as in an equilibrium, that you would want to go and fix a debt problem. You do not want to deal with it when you're stuck in a corner. So
yeah. Okay. Awesome, Rabih. How you feeling? Feeling good?
Yeah, good.
Exhausted?
I still have talking points, but I'm exhausted.
Yeah, we'll save them. We'll tease them for next time. We're going to have a ton to talk about on all these topics. If you want to talk to us, if you want to share your story, see how we can help, if you're a dentist out there thinking, man, I'm listening to these guys for a long time and want to talk to them, you can talk to us. You probably can't get to Rabih. That's special. We keep him behind a special wall. But you can go to dentistadvisors.com, click on the yellow book free consultation button. We'd love to talk to you, hear your story. If there's things that you want us to talk about on this show, you can go to our Facebook group. You can go on anywhere I think Spotify now has comments. You can leave comments. You can leave comments on the Apple podcast. Anywhere you're getting podcasts, you can leave us a rating. You can leave comments. We'd love to hear what you want us to talk about. We love feedback as well. So thank you everyone for listening. Rabih, thank you for being here and sharing your infinite wisdom and knowledge on these things. That was our 2 cents. Till next time. Bye-bye.